who should raise money, why they should raise money, and when they should raise money.
Fundraising is not a goal. We would all be happier if we didn't need to fundraise.
My guest today is Raymond Luk. He's an author, a coach, a VC, an angel investor, and an entrepreneur for the last 25 years. He had a very successful early-stage VC firm called Year One Now's out of Canada, and he currently sits on the board of directors of Airbnb. His company, Flow Ventures, has been recently acquired by Deloitte. He's very passionate about entrepreneurial finance and founder education, and he's on a mission to teach founders to tell better stories, write better pitch decks, and raise better funds.
When you're raising pre-seed or seed, you don't really have any real traction, right? Let's just be honest. So you're selling dreams, baby. That's what you're selling. People get so fixated on measuring themselves by how much money they raise, or if they in fact raised. I meet entrepreneurs every day who are kind of apologetic. Oh, we haven't raised any money yet. And I said, well, congratulations. People think that it's a signal of success or it's validation, but it's not really a signal of anything, right? It's not yet, at least.
What do you look for in a founder before you invest?
I look for a real reason that they care. I always ask, like, why do you care so much about this? Why do you care so much about valuation? Why do you want 10 million and you would not accept 7? They don't have a good answer, except 10 is better than 7.
What's one contrarian opinion you have about the future of entrepreneurial finance?
I love that question. I think that...
Hey Ray, welcome to the show. How are you doing, sir?
I'm doing great. How are you doing today?
Awesome. It's a busy day, but so good to have you here on the podcast.
It's a pleasure to be here.
Thank you so much. All right, so every single time I happen to invite anybody on the podcast, one of the first things that I ask them is, what's the earliest context they have of their life? Who you are, where you're from, how did you end up here? Give us the earliest context of who Raymond Luke is and how did you end up here?
That's potentially a long answer. I promise not to tell you my life story in real time, but one of my earliest memories of growing up, actually, if I think of the very first, this is not interesting to anybody but me, but the very first memory I can think of as a human being is I was in a cradle and I was just kind of standing up. They have those bars, so standing up like a little prisoner and looking out at the room, and there's some drapes kind of blowing in the wind. And for some reason, that is the first memory I have. It's just this little human being, caged, not unhappy to be caged, but definitely wanting to get out and explore the world. And that actually was in my parents. They owned a store in Toronto. My parents were immigrants from Hong Kong. And so they, like a lot of immigrants, did all kinds of things. My dad was a PhD and taught at the University of Waterloo. My mom was a geography teacher. They also ran a plumbing store, a soda bottling company, like a convenience store in Chinatown, all in a weird order. And then we moved around. So this first memory happened at that store upstairs. And I think about this a lot because both my parents were really teachers more than entrepreneurs. I think that some of my entrepreneurial DNA was set there, watching them run this store, leading a very different kind of lifestyle, living upstairs. And of course I was an infant, so this is all would have been just soaking things up in the subconscious. But maybe that's come back and it's like, hey, I'm an entrepreneur. I don't know why, but my DNA is telling me to go here.
Okay. What was it like, growing up with parents who were teachers and entrepreneur at the same time?
It's funny how things work out that, I really love teaching, and I'm actually doing more and more of it. And I'm finding ways to do more and more teaching in what I do in my work and work with entrepreneurs and fundraising. So I think I've always moved between those two poles. On the one hand, being really interested in business and entrepreneurship and creation. On the other hand, being really interested in teaching and explaining things, mostly because I think I figure out life and learn by teaching. I think most teachers, a lot of people think that way. Probably students are probably terrified when they hear that. I thought you knew everything and now you're telling me you don't. But, so I think I've gone back and forth and for sure, I think there was an imprint of my family and a lot of, probably common with a lot of immigrants. It was just that hustle, that fear, that elation and need for security and feeling a bit of an outsider, which are all so useful when you're an entrepreneur. But I think, growing up, I was always entrepreneurial. I was like a DJ. One summer, I took out they had this weird government program in high school where they would just loan any foolish person $3,000. And then you could start a business and then try to pay it back, but kind of no worries if you couldn't. And so I started this business where I would DJ these dances, like, teen dance party kind of things, and actually made enough money to pay back the loan. So that was really great. So I've done a lot of little things growing up, probably, like I said, imprinted with just my surroundings. And, if I kind of fast forward through my whole working career, it's always been about working with other entrepreneurs. A lot of it's about finance and kind of empowering other entrepreneurs, helping them raise money, helping them with their strategy, trying to build products to solve those issues. And I think I've always loved entrepreneurship and working with entrepreneurs, and I think that's probably why I keep coming back to that. I wouldn't know how to do anything else.
Okay. I had a pleasure of, meeting with Ben Yoskowicz and Alistair Crowe, like both on the same podcast.
Two fine gentlemen. And Ian Ray was the other person who was part of our little group at Year One Lab.
Yeah, I need to invite him as well. So, that comes to full circle. So probably can have like all four of them.
He would be a great guest because he has a really interesting story. Okay. Recently, he sold his company to a much larger company and then took over as CEO of that company. I don't remember the name of it, but there's a story that to be told there.
Absolutely, I'm gonna reach out to him. And they both mentioned one thing. The whole story thing kind of started with Year One Labs. Is it still going? Is the project like stopped? Like what's happening with Year One Labs?
Year One Labs was the most accurately named kind of micro VC in history.
Yeah.
So we thought that calling it Year One Labs, really what it meant was that time period from 0 to 1, right? So for some people it's less than a year, some people it's more. Mostly it's more, by the way. But the idea was we wanted to fund that part of the journey, helping entrepreneurs go from 0 to 1, whatever 1 means. And we did that successfully. We were going to run it as kind of a yearly cohorts, and we were raising more money. And then, the problem with having 4 entrepreneurs try to do a fund is then all 4 entrepreneurs decide, I want to be an entrepreneur. I don't want to be a fund manager. And so we all went and did that. So Year One Labs ended up being the 1-year fund. And so we were true to our branding, I think true to our name. It was accurate. Of course, if you know anything about funds, like you can't exit out of a fund in 1 year. We wish. So roughly around when Airbnb went public, that was our 10-year anniversary of the fund. And that was when we were able to, because we were fortunate that we were shareholders of Airbnb through an acquisition. And so most of the fund was just, like a lot of funds later stages, you're just waiting for exits. And so we had a couple of exits. The Airbnb one was the one that returned the fund. And so there was a lot of waiting. I mean, it's happy waiting, right? Because Airbnb is going to do well. But I was the managing director, which is a very fancy title, and it's a really fancy corner office, a lot of great catering. What it really means is after the money comes in from the IPO and you're happy to send it out to your LPs, there's a lot of administrative work to be done. So I got to wear that. I'm still wearing that hat just because wind down stuff takes time. But I consider the day that we wrote checks out to all of our LPs and our advisors, because we were unique that you hear a lot of accelerators and funds have advisors, but we had a high bar for our advisors, not only the quality of people, but we said you need to dedicate a minimum number of hours to Year One Labs, because we really want our companies to have access to you, not a vanity metric on our, like, hey, look, we have Toby from Shopify, look, and then you reach out to Toby and he never wants to talk to you. We had a great group, including Toby, who did want to talk to our entrepreneurs and did regularly. And so we were really happy to write a very small but a meaningful check to those people, because I think, myself doing a lot of advisory work, nobody does it for money, hopefully, otherwise you're a bad advisor. But it is nice to know that, because you had an impact, you you got something in return, and that kind of closes the circle in your mind. So we're really proud of that.
Okay. What's good advice in your opinion?
I think it's, boy, we could talk about, let's go there. I love talking about this because the reality is there's so much advice out there for entrepreneurs. And I think the first way to answer that question is good advice sometimes is no advice. And I tell this to entrepreneurs all the time, because often I say, the best thing you can do is just stop listening to everybody, including myself. So the last piece of advice you should listen to is mine right now. And my advice is don't listen to advice, because there's so much noise already in being a founder. And the startup world attracts a lot of advice givers. I'd say a lot of people do it out of the kindness of their heart. They have the right intentions and they are smart and they give great advice, right? I have no issue with that. But it's really difficult for founders to tell. And when you have 100 people giving you advice, I think there's this assumption that, which I've never seen any proof for, which is your job as CEO is to filter out the noise. But how do you do that, right? And one of the kind of myths out there is that I always tell people is don't take advice from successful people. And they think that that's...
Why is that so?
That's nuts. Why would you not take advice from successful people? And yeah, it's a bit of a challenge, right? It's what I mean by that is that when you sit down with a billionaire or somebody who's really successful, your mindset is already wrong. You assume that everything they say is a secret, that once you know the secret, you can just apply it, or everything they've done, whatever words they're going to tell you in their advice, it's really something they know that you don't know. And often that's not true, right? Often the circumstances between that successful person and you are completely different. And the example I give is like, if I sat down with Serena Williams and I asked her what's advice for me to win a Grand Slam in tennis, hopefully she'd just say like quit. But there's really no advice she can give me that will improve my tennis, right? Besides practice. So I think that it's a complex issue because there's so much bad advice out there, because there's either too much advice or this is idea that let's put somebody up on stage who is more successful than you as the entrepreneur, which number one makes the entrepreneur feel bad, right? And I felt that many times in my life, is seeing somebody really famous on stage and thinking, why am I'm not as successful as that person, and I feel really bad about that. In reality, that makes no difference to you to be successful. And the best thing you can do to be successful is probably tune it out and run your business, right? That's what successful people do. It might be fun and you might feel good, kind of like if I was sitting next to a famous movie star in business class, something, I feel good about it, but they're not really going to teach me anything about my life. And so I'm not actually saying don't spend time with successful people, but it's actually hard to translate what they're saying into something that's useful, beyond what I said about Serena Williams, besides go and hit 10,000 hours of tennis balls and then come talk to me.
Yeah, I always wanted to know like what a good advisor looks like. So a lot of the times you would see there's people like, say, especially on LinkedIn, they're like advisors in 15 different startups. Sometimes I do wonder like, okay, like what advice you would be giving to 15 different companies, because everybody's in a different category, everybody has a different challenge, everybody's building a different thing. So how can you be good at like providing advice to 15 people at the same time? Kind of doesn't make sense, but maybe some people are that good.
It can be done. Like I'm just thinking I'm picturing in my mind this LinkedIn post, right? This of somebody who's like, I'm an advisor to number one, like short LinkedIn things is probably not where I go for advice, even though I publish all kinds of stuff on LinkedIn. I think that the idea that like what entrepreneurs need is the practice of being an entrepreneur. So I used to be a musician. We skipped over that part, but my first career was as a classical musician. I played piano. I was a composer. I studied, like my 20,000 hours in learning something was in piano. So it really, besides growing up in an immigrant household, the other thing that really shaped me was music, because it taught me the superpower of repetition, that you have to be a good pianist, you have to do it, just like to be a good podcaster, you have to do it over and over again. And so, my answer to about the whole advice topic is I always separate it that if you give me some advice and I'm just inspired and, I'm really happy, then amazing, right? So I love Tony Robbins. I love Oprah. I love, anyone who inspires me, right? But in terms of practical advice, and I mean like advice that actually helps me be better in my business, I kind of divide advice into another category, which is advice that helps me practice, the same way that a music teacher would help you practice. I can't teach you to play piano by giving you top 10 tips for playing piano. You just have to practice it. And when you get to a certain level, then we can talk. But most of the time, entrepreneurs they're just so confused because there's so much thrown at them, so much advice. You need to know this, you need to know this. A lot of it is this, by the way, you need to know X. And then it's 100,000 topics. And then at the same time, you need to sell and run your business. That's not really useful advice. And on the other hand, if it's advice like you need to learn how to sell and I'm going to sit down with you and we're going to practice. This is something we used to do at Year One Labs. It was called cold call roulette. You can't do this anymore because it's like old school. We had a phone book, which doesn't exist. We had a corded business telephone, which doesn't exist. Nobody likes talking on the phone anymore. So, but just go with me here. Picture that two people in a room, like an entrepreneur and me or Ben or Alistair, a couple of beers, a phone book, and we would just dial people randomly and pitch them on a startup idea. And the idea was to help entrepreneurs get over their fear. A lot of, if you're an engineer, kind of a techie, the fear of engaging with human beings. But it's a fundamental part of like lean startups and customer development is you have to talk to people. So what better way than a phone? So we would do this. And the whole point was hilarious failures, occasional surprising successes. But the main thing was just practice. So, but I don't hear a lot of people giving that type of advice. So here's practically a way for you to practice cold calling so you can be better at communication. I hear all kinds of advice on, I raised money. I raised a $10 million round once. So here's my advice to you. And I don't really find that type of it. I try to avoid that. I'm sure I've fallen under the trap, but I try to avoid it. And I try to work on from the ground up frameworks, practice, more thoughtful ways that you can apply. And there's no perfect way to do it, right? But I do want to say, because I was a bit negative about advice, that I do think it comes from a desire to share, which is good, right? It's just the kind of unintended consequences oversharing.
Okay. One of the questions that I had in mind just to ask you was, what's your opinion on media and information that's being available to the founders and how to raise money, how to be a successful entrepreneur, how to exit $100 million exit or something like that?
It's all bullshit. I mean, like, think of it this way: like, if it was true, if I could consume that, why would I even be here talking? I would just be selling my company for 100 million, whatever the thing is. I think that's just the output of the social media algorithm, the desire to have something. It's gonna clickbait. I personally hate that stuff, and I mostly hate it because it's just not true. So I find that it's hard enough being an entrepreneur, but when you're distracted into thinking that, but there's somebody else who just learned the secret and I didn't learn the secret, and that's why they're successful. But it's not true. There is no secret, right? There's no secret to being a great tennis player. And by the way, I'm a terrible tennis player. It's probably why I keep using it as an example. But, there's no secret to being a great tennis player. It's tons of practice and be born with a great body, mind for a both athletic body and mind, and a lot of luck. It's the same with being an entrepreneur. There are things you need to learn, by the way. You need to learn so much. You need a great network. You do need to have some kind of characteristics, but reading those things like how to be a X, or I hate the kind of posts where what does it take to be a successful entrepreneur, and who cares? Like, you need tall or short. Do you need to be this or to be that? It doesn't matter. Just go do it. And it's hard enough, and you don't have time to be wondering like, should I do this or should I do that? And so I just say it's all bullshit.
Yeah. So I have you and I were talking about prior to the podcast about the design studio thing.
Yeah.
So I have a C, which is in our team, and we're like very small team, like 6-7 people team. In our team, there's a fun thing that we have is ugly shit gets clicked. Like that's the theory that I have.
Yeah.
The reason why I come up with that is I happen to come across somebody on LinkedIn that person has worked as a software engineer, something as a team manager level or something like that. And all of a sudden he has in his title, he's managing $1 billion VC fund. I was like, okay, maybe, life happens. Okay, something like that. And now he runs a whole coaching business around that. He charges you $1,000 an hour, teaching you how to fundraise. That person never built a startup, never raised money, but he teaches everybody charging $1,000 an hour. So he's pretty good at sales. Like that's obvious, right? And then he would come up with these LinkedIn, the long form posts, like pretty big ones, every single day. And the title would be, do this to raise your next seed round, Series C round or something like that. Do not raise from X, Y, and Z, like brand name, venture capital firm or something like that, unless you read this thing. So yeah, I came up with that, like ugly shirts get clicked, like, people just, and it gets views.
Ugly shit gets clicked, like naked stuff gets clicked, like whatever.
Oh yeah.
Between those two things. But listen, like we all take some responsibility for that. I mean, we're the ones who click, right? So I don't personally like that approach because it just doesn't work. But I also think that founders need to be kind of critical with what they consume, just like we do as citizens. That seems to be a dying art, is just to be critical of what you read. I don't know if people even read anymore, right? But I think that, it goes back to what we were saying before, that we're all after short answers and we're all after shortcuts. We're all after this idea that if you only knew this secret, you could just jump to the head of the line. And that's just not true. Like, it's just, I wish it were true, but it's just not. And hate to break it to everybody listening. But it's better that way, right? Because when I think of a secret, and I think especially in technology and venture, it's very exclusionary, right? It's designed to be exclusionary, partly for good reason, because you have to invest in the outliers. So that's automatically means you're saying no to most people. But it's also exclusionary by race, gender, age, geography. The numbers don't lie. That's just how it is. And there's like good exclusion, which is be better, be elite, and, succeed. And that can't be everybody. And then there's bad exclusion, which is who do you know? What do you look like? And these kind of secret clubs and secret terminology. And because I think that's bad because it stops people from achieving greatness. So I think that that's something that I always push back against, that hearing somebody say, well, I am this person and I'm successful, here's what I did, that might be valid, but that may completely not apply to you. And you shouldn't feel excluded from pursuing your own path. It's going back to what I was saying earlier about don't take advice from successful people. It's, at the end of the day, you have to chart your own path. And if you rewind to every person you look up to, Elon Musk, Steve Jobs, Brian Chesky, whoever it is, right? If you rewind to the first time that somebody made a bet on them, or even before the first time they made a bet on themselves, they were the same as you. Completely clueless,
100%,
scared, bullshit, hoping to be in the right place at the right time. And it's all the same, right? And sometimes I feel like everyone's dream is build a company, be successful so that you could write that LinkedIn post giving everybody else advice. So that's just the way the world is.
Yeah, I totally agree with that. So one of the goals that I have from, our conversation is I want this to be somewhat of a masterclass on fundraising and pitching. And the reason why I say that is because most of the people who listen to the podcast, who watch the podcast, they're like aspiring entrepreneurs or like first-time entrepreneurs. They're yet to face either those challenges, or they're like already facing those challenges but do not have the answers. So and fundraising, to a decent degree, that still remains somewhat of a mystery, because it's just like, there's no perfect book, there's no perfect path, and like just do this thing and you're gonna raise it around. Okay, so most of the questions that we prepared and the research that we did is keeping your amazing background in mind is around fundraising.
Yeah, love talking about fundraising.
Yeah, okay, perfect. So my first question that I want to ask you is, who should raise money, why they should raise money, and when they should raise money?
Yeah, I mean, those are all three of those are related, right? I think that first thing I'd say is fundraising is not a goal, right? We would all be happier if we didn't need to fundraise. And it's obvious, obviously, I don't, if I didn't have to have a mortgage, I wouldn't have it. Um, and, but it's sort of silly to think about it that way. But on the other hand, people would get so fixated on measuring themselves by how much money they raise, or if they in fact raised. I meet entrepreneurs every day who are kind of apologetic. Oh, we haven't raised any money yet. And I said, well, congratulations. So who should raise and all that stuff? There are a lot of businesses that don't need to raise money, and there's pros and cons of that. But what matters in that context is what the kind of business you want to build. And there's all kinds of research about, the actual payout of being a sole owner versus being a VC-backed company. There's a great book called The Founder's Dilemmas by Noam Wasserman, which I just think everyone should read, because there's so much data there that is kind of contrarian about fundraising, but we can have a lecture about that some other time. But I think the actual key part of what you asked was, when should you raise money? And I believe that you should raise money that like the latest you possibly can. Most people say like raise money when you don't need it, raise money sooner because you never know what's going to happen. And, I think that might be true if you have a traditional business like bricks and mortar and you need a bank loan and, shit happens. But in a product business and like a startup, let's say, because you don't have product market fit yet, no matter what you think, it's really hard to have investors and a lot of money raised when you're still figuring out what business you're in. Of course, most venture-backed startups have that, but the earlier you raise, the more that you've made a promise that we're going to go in this direction with this product and this is what's going to happen. And yes, investors know it's kind of bullshit and it's a dream, but in the back of your mind, you're now spending some time processing, but I told these people I'm going to do this. So I can't just focus on pivoting hard left when it's the right thing to do. And the data is saying that. I have to think, but is that going to erode their confidence in me for the next round? And that's kind of a distraction. So I think that you should wait as long as you can. And what that usually means is hire fewer people, grow slower, bootstrap it. It's suffering, eat less calories, sleep, you're working tomorrow. You know what that's like.
Yeah.
It sucks. But the alternative sometimes is worse, because now you have some people who have this expectation. And the worst part is you start to believe your own expectation, because as a founder, you must be certain. Now, rule number one, always be certain. And it's when you're fundraising and you've got people, it feels good. You get the article in TechCrunch, you get some money in the bank, but there's this idea, now grow. But it's hard when you've raised, a couple of $1 million, let's say, to say, we're not going to spend any of it because we're not ready for growth. We just need to experiment. And there's going to be hundreds of failed experiments, which we only need 2 people for before we decide what direction we're going in. It's very tough to have that conversation.
And, to your earlier point where you mentioned that, you get somewhat of a media or a press, like, you get an article in a TechCrunch, or, people would just go on and celebrate like, hey, we just raised, I don't know, seed round or something like that, and that much amount of money. And that is kind of celebrated like a lot. Like, a lot of people actually have this false notion that, okay, that's the point that we need to be. Like, I was at the airport, like that was long time ago. Met a guy, and then he mentioned something like, what are you doing? I was like, we're just like meeting people to raise, 1.5. And he went something like, oh, you've done it. My friend, yeah, I have not done like anything. If anything, like I've not done it. So I think this is another false notion that, maybe if we manage to convince people to, give some money to us, that means success. I think it's totally the opposite.
People think that it's a signal of success or it's validation. And it's mostly like, listen, don't get me wrong. I love reading that news because I celebrate other entrepreneurs and I know how difficult it is to raise. So I'm just happy and I want to send them positive feelings, and it's a huge achievement. But it's not really a signal of anything, right? It's not yet, at least.
Not even a validation? Like sometimes people think, oh yeah, okay, maybe, so somebody giving us money, that probably means, one, they believe in us, two, that we might have find the product market fit. Somewhat of a validation, I think.
It's not validation. I mean, later
Okay.
on, like a loan is validation, right? Because a loan is only going to happen when there's fundamentals, and a strong balance sheet and a P&L and a stream of cash flow, and so that you could argue is validation. Early stage funding is, yeah, it's a validation of I believe in this entrepreneur, but you have no real signal about the quality of the business because it hasn't happened yet. Like that's like I want to be clear that I'm not saying that it's a non-signal because the entrepreneur is bad. It's just that the business hasn't happened yet. So you because even if everyone's eyes are open, seed funding and pre-series A, even Series A funding is all about investing in the experiment and hoping at the end of that the experimental results start rolling in. But you never really hear about the experiment. That's always secret. You just hear about the funding. It's like we
Yeah,
we built
exactly.
the lab, but we're not telling you the results. But more people are investing in the lab. It's fancier now. So yeah, is that a signal that the experiment's working? I have no idea. I think that nobody shares how big their mortgage is. So that's one thing I'll say personally. Um, and I think that people should share more of their sales, their metrics, like, and the media and journalists should write more about that, because that is not only really useful for that company to attract the kind of funding that wants that, but it's real. It's a real signal. It's a real achievement, and it's an output, not an input. So, that's pretty rare to see people write about a company hitting its first million users or its first million in revenue that's not attached to a funding round. Why is that?
Exactly.
Don't know.
Okay, maybe because that doesn't sell as well as we just raised it out. Maybe that sells quickly.
Yeah, it's when you really peel back the onion or pull the
Yeah.
thread, whatever analogy, it really makes sense. It makes no sense that we attribute so much value to the fundraising. And don't get me wrong, that again, we should celebrate entrepreneurship, and if that gets more people to jump in, amazing. But my point is, there's so much good news that we are not talking about when we're only talking about money, like money going in. How much good
Exactly.
news? For example, the company that is kicking ass but doesn't need to raise money. I met somebody the other day. It's at an event, and she runs a business that is never raised money, is going to hit 10 million in revenue, profitable, and
Wow.
nobody's ever heard of this company. I'd never heard of them, but I think I would like to hear about them, right? I think that's what I want to hear covered is real innovation, real success, real growth. But I'll never hear about it if the only way that we read about it is because they raise money.
Yeah, totally makes sense. Okay. So what's the thesis behind behind Flow Ventures and HockeyStick? And why you like both started, like both of these are like totally different. I think one is like a fundraising platform, the other one is a fundraising firm. So why both exist, and what's the thesis behind both of them?
Yeah, it's funny. Like I should have just started them. I should have just started one company because they ended up kind of doing the same thing from different sides. The looking back, like my thesis has always been the same, that what bothers me is how difficult it is for entrepreneurs to raise money, full stop. And it's always been difficult. And it's kind of unnecessarily difficult. Like it's annoying, and it suppresses innovation, and it's unfair. And I think that that's always motivated me, probably because when I started, I was not a finance person. I didn't have a business degree. I had a classical music degree. And so I was self-taught, and so I had to struggle through learning and figuring all this stuff out. And so, with Flow and HockeyStick, they're both approaching the fundraising problem from two different angles. Flow has always been about all the types of funding that are not venture capital, because the majority of funding is not venture capital, right? It's loans, grants, maybe your own family, your own pocket, customer sales. Like that's the lifeblood of most business is that. And so Flow has been around for 17 years, helping technology companies with everything but venture capital. And probably because when we started 17 years ago, there just wasn't that much venture capital in Canada. And so it'd be silly to start a business there. But there's a lot of innovation, and in Canada, the government programs are kind of a replacement for some of the angel and seed funding that exists in other countries that just doesn't exist here. HockeyStick, that kind of was started later, was started because when we started thinking about what are the challenges to raise money, one of the challenges is, well, people just can't find each other. Investors can't find companies can't find investors. It's all kind of very old school, old world. It still is, unfortunately. But so the idea was that, when you think about questions at the beginning of companies, so I wonder if, so the question there was, I wonder if technology could help money and companies find each other. So we ran all kinds of experiments in data and matchmaking and software. And so we were successful in helping entrepreneurs, kind of put entrepreneurs and investors together, which that's what we really cared about. Like, we weren't a broker, and we weren't paid as a percentage of, whatever. I've never really been interested in that type of business. What I cared about was, can we get people together and build relationships, which obviously hopefully leads to funding. But even if it doesn't, can we build relationships? And this was it turned into a big issue during COVID, when people forget that before COVID, the majority of venture happened within 100 miles of where the VC lived. And that was just one of those set in stone kind of mantras. Now that's not the case. Like, that's the only gift COVID gave us, I guess, is now deals are done over Zoom every single day. So that really, people really started embracing platforms like HockeyStick and just opening their minds to different ways to raise money. Now, really the companies are now the same company, or the same family of companies. And because we realize that the entrepreneur in the center is the same person. And so that entrepreneur might not raise money for venture, might not get grants or loans every single day, but they're the same person. And we really care about serving that founder throughout his or her journey, which, 20-year journey, however long it takes. So I think the thesis is applying technology, applying data, applying smarts to making fundraising more rational. Not easier, more rational, I think is better to say.
Yeah, it's never easy, I think. It's never easy. Like, regardless of the economy, regardless of the eras, it's not easy to raise money, right?
Yeah, and the other thing that I think over the last couple of years that I've come to realize, and I've diverted a lot of my energy towards, is realizing that there's a real education gap with founders. And when it comes to raising money and all of that. So I realized that you could build the best button in the world that helps people raise money. But if they're not educated about fundraising and what that actually means, they won't even know to press the button. And I'll give an example of that, I run founder workshops. And when I'm in a room with founders that's private and there's no VCs, there's no outsiders, people kind of more readily admit that they don't know a lot of like, they don't understand cap tables, for example. They don't understand how to do competitive analysis or financial projections. And of course they don't know. They're busy just building their damn business. They're not going to pause and do an MBA. But I realized that without that knowledge, how do you know what vendor to hire or what advisor to hire, what product to use, what valuation is right for your business? And even some of the questions you asked, should I raise money and when should I raise? If you don't have the fundamental knowledge, you won't even be able to get very far answering that question. So I've been really thinking about what are the fundamental things that founders need to know. And that's what I've been writing about and teaching about, and really trying to crack that nut, because it can't be everything. You don't need to know about tax. That's the good news. You don't need to know about everything, but you need to know a little bit of finance, a little bit of ownership, a lot of storytelling, sales, people. There are some topics that you actually do need to know, and they're really poorly taught.
Absolutely. So you raised money, I think, in Canada, and you worked with, venture in the US. So how are the two markets that differ from each other? Like, what's the scenario looks like to you?
Yeah, I mean, the big issue, the big difference that's between Canada and the United States is there's just a lot more money in the United States. And especially at the early stage, you just have a lot more options. It is easier to raise money at the early stage, and it's gotten a lot better here in Canada. Like, when I started out, there were very few VCs, very few angels, no seed funds at all. And I started one of the first accelerators in Canada. So there was, it was bad. It was like the jungle, the desert, Now it's better. But if I'm being honest, if you go to Boston or the Valley, it is much easier. Not easy, but it's easier because there's a lot more people in the United States who will write a $50,000, $100,000 check, just because. Here it's much more difficult, and it's not a complaint. Like I'd always tell entrepreneurs, don't whine about where you live. If you don't like it, move. If you want to live here, and there's so many great reasons. Here being, I'm in Toronto. If this is where you live, then there's no excuse, right? Just be aware of your context. I think one really great thing now is there's a lot more venture in Canada, but also US VCs don't think twice about investing in Canadian companies. It's happening every single day. So we're more of an integrated venture market now. The difference is it is harder at the early stage. And that's why a lot of Canadians will go to YC or, go to an accelerator or raise money elsewhere. And that's a smart thing to do. If that works for you and you can do it, go for it.
What's your opinion on YC now that you mentioned that? And the reason, so particularly, the reason why I ask you is since I met Ben, I admit, still a student of venture and entrepreneurship. Like I did not know this whole concept behind Venture Studio. So I used to think there's an accelerator and then they do all that stuff. But that was the first time, and he taught me so much about Venture Studio in that 2 hours long podcast. And then more and more I just learned about that. And now I kind of realize I have this sort of an opinion, maybe we need more Venture Studio than venture capital firms. That's what kind of leaning toward. Maybe that's wrong.
Of course, Ben would say that. Self-serving guy. I mean, no, it's we need both. I love the Venture Studio model. Apparently, there's lots of people who don't like it because they feel like venture studios take too much equity, and I feel like that's unfair criticism because that's more like saying because I can't get what I want later by investing and taking a big chunk, I don't like venture studios. But probably the answer from people who run venture studios is, well, we don't want you. There's plenty of other types of investors. I think that they're very different. I think what I love about venture studios, and I think there should be way more, is that with venture studios, your number one is you're optimizing for let's actually build something interesting, and you're not optimizing for let's help companies raise money, which is how a lot of accelerators are structured. So venture studios, if they're done well, they're normally formed by industry experts who can be hands-on, who can really jump into that experiment along with the co-founders and take the time. It may take more than a year, 2 years to find if you've got something. And it's almost like the company isn't started yet, which I like. Remember I said at the beginning, delay your start. So it does incubate this idea, which also makes it easier to kill the idea if it doesn't work, which is the right thing to do, but hard to do once you've raised money. And I think whatever graduates from that, it may not look or be structured on the cap table the same way as a regular startup, but my attitude is, who cares? Show me a VC who is going to see a graduate of a venture studio who is amazing, but just says, you know what, I'm not going to invest in that. They will find a way, right? They'll find a way. But on the other hand, I'm not saying that everyone needs to go through a venture studio, because a lot of, what is a company? A company is a little incubator of itself, right? It's its own experiment. So if you've got some people who are able to do it themselves, that's just a regular startup. You don't need a venture studio. You need both, but I just think that there's real room for it, especially on the corporate side. If I think of all the big corporations, what they shouldn't do is start corporate venture. Not never, it can work, but I think the missed opportunity is with big corporations. They have huge resources to pull products into a market. So imagine a cybersecurity startup, and their hardest thing is selling into big enterprise. If you are a big enterprise, you could incubate that startup inside your own company, which other people, I think Deloitte has done this successfully, and they spun out a company that's in the security or in the contract management. That's it. I don't remember the company, but I think that model of take the thing that you have, which is not not just money, but the advantage of market pull and access to experts and customers, that poured into the startup makes it valuable. You can always spin it out later. That's the venture studio model, which I think can really work.
Okay. Yeah, going back to my previous question, which was like, what's your opinion on Y Combinator? And like now is almost a time where like, people are applying.
Yeah.
And my LinkedIn and Twitter is like full of that. It's like every other
Yeah.
post is about, this is how you need to apply. This is what you need to do. Send me your application. I'll take a look at that.
Yeah, it's like the advice YC industrial complex.
Yeah.
Like I feel like if you're a startup, you should apply for Y Combinator, right? Why not? And you should, give yourself that opportunity. I think it's a great program. I think what I really love about YC is just what they've done for the community and for things like education and startup school, which is freely available. I think they've really invested in trying to solve some of these educational problems, inventing the safe note, which, there's pros and cons of the safe note, but they invested in standardization, and they didn't do that just for their own benefit. They did it for everybody. So like, I feel like it's a great program. It's obviously a juggernaut, right? It's you can't just duplicate YC somewhere else. They have incredible alumni, that all that market pull stuff. There's lots of other, like I do a lot of work with Techstars. It's also a very different model, more decentralized, but also a great platform. I generally very positive on accelerators because when they're done well, it can really, it can happen in that perfect time when the founders know they want to start a company, so they're dedicated, but they just need a little bit of finishing school to be ready to really accelerate to their next step. That is that process I believe it needs to be longer than, I think 3 months is the average program. I think it's way too short. Besides that, I think the idea of accelerators is really good. Of course, there's some bad accelerators out there, and just like there's bad companies and bad VCs, but generally I think YC is hugely, they're a big contributor to global startups.
I totally agree. You mentioned one thing, which is they're like pros and cons to SAFE. What are the pros and cons to SAFE?
Well, the first thing is, I think startups need to understand, the real con of SAFE is like you do need to understand how it works. Like I meet a lot of founders who they'll say like, yeah, we're raising a SAFE, and I was like, why? And just for fun, like I think they should raise a SAFE too, but just to be a bit of a jerk, I'll say, well, why? And they don't really have an answer, right? It's because YC told me, Paul Graham told me to do it. And I think SAFEs in general are perfect, wonderful, amazing, easy, all that stuff. But I think founders don't realize that they just don't realize some of the mechanics. So I made a whole video with Jenga blocks explaining like SAFEs and cap table mechanics, because a lot of people, for example, don't realize that there's two types of SAFEs, a pre-money and a post-money. The pre-money was the original one, now it's post-money. But with post-money SAFE, you think that, there's no valuation because that's easy and we'll figure that out later. But it's not true, because the post-money SAFE has a cap. Good luck trying to get an uncapped SAFE these days. So if you have a $5 million post-money cap, that's literally the valuation that they're converting into. That's what I mean. So a lot of people don't understand that, and then people don't understand there's built-in anti-dilution protection. They don't call it that, but that's what a post-money SAFE means. It means that no matter what, if I invest $1 million at a $5 million post-money, I get 20%. And I don't care how many other people invest, I still get 20%. So
exactly,
that essentially means anti-dilution, which no entrepreneur would agree to, but it just kind of sneaks in there.
Yeah. I think people don't know that. People don't know that. Like,
well, they should watch my video, because I literally explain it. And that doesn't mean it's bad, right? It means like, I think go for it. There's nothing wrong with any of those things, except that I think so. Really, the answer is it's deceptively simple, or the simplicity of a SAFE is deceptive. It's not actually simple, in spite of what the S means, simple. You actually need to understand it, and it's a good example of those many things that unfortunately founders need to know a little bit about it. They can't just phone it in. And in some cases, I mentioned, like for bridge rounds, for example, SAFE is not the thing to use for a bridge round. You should use a convertible note. And the reason is because when you're raising a bridge round, what you're really saying is, we're not ready to raise the next round. Please give us money. And it's kind of weird because you're in between and it's kind of not ideal, right? So a convertible note is great because you get a bit of safety, you get some interest, and you're a creditor. But you also get downside protection and you get the upside protection that if things work out and we bridge successfully, then when we raise the next round, you get the same amount that you would have, right? But because entrepreneurs don't really think about it, when they're out there raising a bridge, they might just turn their nose up at a convertible note but not know why, and then actually scare away an investor who otherwise would have said, you know what, I'm taking a bit of a risk, but I don't mind because I'm a creditor. I'm ahead of all those other investors. All right, maybe I'll write that check. And so people should just think about it.
You talk a lot about, pitching and, alongside with just fundraising, because I think there's a better half of fundraising, and that is like pitching starts with a pitch, right? So before I jump onto that question, I want to know, like, there was something that you mentioned that was the rule of gaming and simulations, and how does that correlate with entrepreneurship? So I want to talk about that before I ask you plethora of questions that I have around creating pitch decks and pitchings.
Like I grew up playing board games, like Monopoly and, and Risk, all those games. Like, I don't know if people play these games anymore, but it's great because they're fun and they destroy friendships. I was really passionate about it, and I'm a gamer as well. Like I love gaming. But the other thing that I've been really thinking about, why entrepreneurs don't have this knowledge, because every entrepreneur I've ever met is smart. They're lifelong learners like you, and there's no issue there. And higher intelligence than average, let's say, that most people learn on the job, which you have to do. But I think it back to when I was a pilot. So I used to be a recreational pilot. And so I'd like fly my little plane around, and I was really fascinated by learning how to fly a plane. And one of the things that you do, and anyone anyone can get a pilot's license, and anyone learning to fly now, first thing you do is you download Microsoft Flight Simulator and you practice, and then they have other types of simulators, and they have professional simulators, and it's all done and it's all measured. But we don't have anything like that. So we kind of expect entrepreneurs just to run it. It's like, do surgery for the first time or fly the airplane for the first time and we'll figure it out. So marrying those two things, right? Kind of, why is there so much simulation in other industries, and also my love of gaming? I've been thinking a lot about, well, why can't we use gaming and game concepts to teach entrepreneurship, teach fundraising, teach anything in business. So one of the things I did was I invented this card game called Swagger, which I've done play tested a few times already. It's called Swagger.vc, and it's a VC simulation game that I use to teach entrepreneurs how venture works. Because anyone can go to the Google how venture math works, and their spreadsheets, and it's simple stuff, but they won't really understand. So the game I invented was this card game where you play a VC, you deploy capital, and then shit happens. And it's the shit happens that is the interesting and fun part, because just like in real venture, you can't really pick the winners. You don't know what's going to happen, but you have to build a portfolio, and that's going to generate a return. So it's really fun. It's something I'm working on. And then another idea I have that I'm working on is more a startup simulator, where you simulate all the different things that could happen to you. So whether it's your co-founder leaving, your board member hating you, you lose a major customer, you get sued, all these things that hopefully not all of those things will happen to you, but some of them will definitely happen to you. But the idea is, if you ask yourself, like, why can a bunch of people not get together and play, just like we play Monopoly, play startup, and not just for fun, but for education and learning. If we run those repetitions, then by the time you start a business or run your business, those concepts are not foreign to you, right? And it could be anything. You could simulate safe notes and convertible notes and preferred shares and cap tables and exits. But I think that that's a real missing piece, and it's a much better way to teach versus a spreadsheet. So stay tuned, but it's something that I'm working on. And if you want to help playtest, let me know, because I'm actually, if this is going to become a real game, I need people that play it and then and tell me if it's good.
Okay. Yeah, I'm up for that all the time. Okay. All right. So going back to, this is just like an random thing that I need to ask you, but now going back to pitching and creating those pitch decks and stuff like that. So I assume, and I think rightfully so, that you have seen like thousands of startup pitches. Like that's what I assume, and I think I'm not wrong. And you probably get like all of them in your LinkedIn, like, hey, look, hey Ray, my name is this, and here's my pitch deck. So
Yeah.
that's the most common way these days. Name and a pitch deck. What are the most common mistakes founders make when pitching any investor? Could be angels, could be VCs, could be anybody. And in your opinion, how can they actually avoid those faults?
Yeah. Listen, like, I've got bad news and more bad news. The bad news is that before you even think about how to make a great pitch, you actually have to have a great strategy, like a great idea behind your business. So you can't have it's really hard, I'd say, to have put a great pitch on a bad product or a bad idea or a bad strategy. So a lot of people struggle with their pitch, but what is a pitch deck? A pitch deck is really, it's a story, and the components of the story are all things that hopefully you thought about, like your product, what makes it good, the competition, the future. So if you haven't thought about those things, or you haven't thought about them well, then your pitch is going to be bad, right? So just one example is most people struggle with the competition, how to tell the story about competition. Mostly it's bad because they haven't thought about it. So it's not a pitching problem. It is, did you actually think about your competition? And there's different ways to do that. So I'm kind of sarcastic about it, but I'm not saying that dumb founders, they always get their competition wrong. Founders didn't start their business to write a stupid competition slide. They started their business because they had a passion. But that passion should lead to who else is also passionate about this? What are all other bad stuff that can happen? And if you don't do that work before your pitch deck, in whatever form it is, like a whiteboard or meditation or a spreadsheet, then your pitch deck is obviously not going to be good. So bad news is there's a lot of work you need to do beforehand. Second piece of bad news is that a lot of the time, like, there's different techniques, and you can read my newsletter and download templates, and that's all easy. But the other thing is that the other bad news is the real heart of your pitch deck is one thing, which is what makes you special. That's what it is, right? Because you're not pitching a late stage company with revenue, and like at the early stage you're not, right? Later on you are. You're pitching a dream, and that has to be special. And I think I use that word a lot because it doesn't have to be better or faster or bigger or more revenue, or it just has to be special. And special can mean a lot of different things, but it's hard to extract that. But if you don't make your story special, nothing else matters. If you make it special, then you actually don't need to include everything on the standard checklist in a pitch deck. You can get it across in an elevator pitch, because what you'll do is you'll engage that person to find out more. They'll say, oh, tell me more about that. I'm going to hit the stop button on the elevator because I want to learn more. So I think that's the piece that people forget, because they're just told, go to the Airbnb pitch deck, which is that seed pitch deck, which is not a good pitch deck, by the way. Great company, not a good pitch deck. And
yeah,
right. But you've seen that thing, like download the pitch deck that created a $1 billion company. But you have to capture something special, a unique point of view, a strong opinion, a contrarian view. You have to have the confidence to do that. And going back to what I said before, how you get that is the work you do before your pitch deck. So a lot of the time when I do workshops, I tell people, okay, this is a whole workshop on pitch decks. Number one, we're not going to talk about pitch decks. Just go read my newsletter. Okay. Number two, let's get started. And then what we do is we do improv, where I give people like an animal, vegetable, mineral, and some business model, and then we pitch each other just fake businesses. But because human beings are natural storytellers, and no matter what culture you are, people are really good at quickly getting to the heart of something interesting. even children are. Once people figure out that, oh, okay, now I understand how to extract it, then they go back to their boring ass pitch deck and they realize it's dead. There's nothing there. It's what's missing is that spice, that specialness. So then those 1 + 1, boom, you're good to go.
So when anybody's raising a, seed round, pre-seed round, like, the early stages, what specific traction metrics you can say that, or like growth signals should a pitch deck emphasize to get like somebody's attention, like a VC's attention?
Yeah, I get asked this a lot because, when you're raising pre-seed or seed, you don't really have any real traction, right? Let's just be honest. So you're selling dreams, baby. That's what you're selling. But there is an answer to that.
Yeah. So to interrupt, like one thing that I also want you to, answer in this question is, most people consider that they have a product market fit. In reality,
they're wrong.
Like, no, they're wrong, right? So yeah, when you're talking about growth metrics and like, whatever the metrics thing, just answer this thing as well. Like, yeah.
And I think like not to, like when I say most people don't have product market fit for years, that is not a criticism of founders. It's more of a criticism of the pressure, a lot of it coming from funders, that I want to see signs of product market fit. Well, guess what? Entrepreneurs are smart. They're calculating and they're gamers. If you say you want something, magically I have that thing, right? That's simple human nature. So the whole idea of growth, like I'll say that in a seed, pre-seed to seed, growth is not the important metric at all. You probably don't have it. What is the way I define seed traction is if you think about the definition of the word traction, it means grip, right? The traction of a wheel on the surface of an asphalt road, or so that's what it means. It doesn't mean how fast the car is going down the highway. It means, is the rubber gripping the road so that it's going to move ahead, right? And so traction at the early stage means, for this particular business, what is the most difficult thing that you've achieved? What is the most hard to achieve number that shows that something about your business is sticking with your market? And that could be some experimental result. If you're a deep tech company, it could be literally scientific experimental results that are starting to show promise, or you're biotech. If you're a consumer internet or B2B SaaS and you're running experiments, that grip is traction is probably not signups, because you can just have a lot of aunties and uncles. It probably means, grip means, in spite of your shitty product and your awful onboarding and your terrible marketing and questionable, unpronounceable name, these 100 people can't stop using this one part of your product. Perfect example of that is Slack, right? Started off as a game.
Yeah.
Nobody wanted to play, but what they wanted to do was chat. And then, so they would have failed in all the metrics of the game, but there was this other metric but this community can't stop chatting on our little chat thing, right? I didn't use it back then. So the whole point is that what grips can be surprising. And that's another part to answer of what you asked about traction. Seed traction is always something surprising. It's always something surprising. It's not, we have month over month growth in users and revenue, and that's usually not true, but that's not really surprising. It's usually at the seed stage, we set out to solve this problem and we thought it was this, and holy shit, it was something else. And it just started taking off and we didn't know what to do with it. That's when you know you have traction. And so I think that a lot of people struggle because they feel pressure to show revenue and growth metrics. I always tell them, tell the more difficult story. And unfortunately, that's going to be different for every type of business. But for me, the key question is, what's the most difficult thing that you achieved? And if you ask yourself that question, that usually unlocks what metrics you should have.
Yeah, that's a very good thing. Okay. So if you have to teach the do's and don'ts of cap table, and I know like we're going to plug that Jenga puzzle thing, somewhere in like all the show notes and like whatever we will do. But if you have to teach like, what are the most common mistakes or misunderstood terms are there on cap table? Like what would those be?
Yeah, most of it, like a kind of common theme is most people just don't really understand not even about cap tables, but it's really about what ownership means. So I've been writing this whole series on ownership. What does a share mean? What does it mean to own a share? And what does it mean to have a convertible note? What does it mean when you sell the business? I think most people don't know what those mechanics mean, but it's really important to know that, because you're going to be negotiating that and potentially turning down funding if it's a valuation you don't like, but you don't really know why. Like, for example, most entrepreneurs, myself included, we're really conscious of giving up more than 50% of the company. But if you separate that, the desire for control, with just being rational and having the biggest outcome, Noam Wasserman actually covers this in his book, that when you really unpack why does control really mean a lot to you, a lot of people can't answer, right? So
it's a good question. Yeah.
They just like, I just want it. I don't know. I just want it. So it's, well, what are you going to do with that control? Well, grow the business. What do you need to grow the business? Money. I need other people. It's like, okay, so it sounds like you actually want more people, but I want control. And there's actually, turns out there's two types of entrepreneurs, kind of archetypes, those who really just want control, and they typically have smaller outcomes, and those that are more free to give up control, they usually have bigger outcomes. In general, that's just what the data says. So I think number one is just understanding how things work. So it's one of the topics that I've tried to create the shortest video ever, or the shortest newsletter ever to explain that, but it's not zero. In terms of other mistakes, I think the one that I hear a lot of, especially now with the market kind of turning, is valuation. So I was sitting down with somebody just a couple of days ago, and she was asking about valuation, and I always, my first reaction is like, I always challenge founders, why do you care so much about valuation? And usually the answer is either they've really thought about it and they're intentional about, I want to not give up so much now because I know I'm going to give up 25% at the next round. And that's a great answer. But a lot of people just don't know. So when I say, why do you want 10 million and you would not accept 7, they don't have a good answer, except 10 is better than 7. So that's not a good way to approach it, because going back to that example, why is raising money at $7 million better than raising money at 10? And there's many cases where it's better. And here's one case. You raise money at 7, the market turns, as it has, there's a downturn. The bar goes way up for what you need to achieve for the next round. But you raised at 7, so maybe your next round valuation is not as high as you want, but the bar is properly set and you can achieve it, right?
Yeah.
Second case, you raise at 10. Now you need to go up higher, and people are saying, but what have you done in the last 18 months since you raised that 10 million? And the answer is maybe exactly the same as the person that raised 7, except you raised at 10. So the bar is much higher. And that is the case in this Series B trough that's happening right now. Same company, different market, and they're not able to raise, and that's catastrophic for the company.
Yeah. Do you think companies are raising at a lower valuation?
Yeah, I mean, not everybody. I think, Carta has some really good data that's they're starting to publish quarterly. That's really good. So if you look at the different bands, like, seed, Series A, Series B, above, the action is happening differently. In general, definitely valuations are going down, and but I think more than that, it's taking longer to close deals. The terms are getting worse, and people are just generally, like, anyone who really relies on somebody else later to invest, which is pretty much all of venture, right? By design, you need somebody else to hand the ball off to. If you're worried about that, then you might not invest either, because you can't be the last money in. If you're a different type of investor, an angel or a different type of fund or a lender, you don't care. It's like, are you a good company now? And we prefer not raising more venture later. So there's, one person's challenges and other person's opportunity. And I do think that for private equity and for lenders, it's, they're probably seeing opportunities right now.
Yeah. The last startup that I used to work with was, we used to work in a fulfillment analytics space. And that surprise to me was, even in this state, in this particular year and time, it was a very manual, system. Like, every single thing was very manual. Every single thing was Excel. Like, there's nothing synced or something like that. So we were like working on that. And we happened to work with a lot of CPG startups. And most of them, I think 80%, 90% of them that we used to work with are venture backed. And I'm not saying like just like, seed and pre-seed venture backed. They have raised like Series A, Series B.
Tough time for those people.
Yeah. And now they're like, shutting down. Most of them were like, we have a couple of months of runway left. Most of them are like, yeah. So why do you think like, they're like shutting down? And the follow-up question is, do you think 2024 is going to be different or is it going to be better for those startups?
Like specifically for e-commerce, like CPG or like DTC companies?
Yeah.
Yeah, I think that, it's tough. I think it's been tough in those, for those companies well before COVID and the downturn. I think that, I'm not sure that, I think the hypothesis was we can apply venture math and venture funding to that type of business. And I don't necessarily think that's proven to be true. A lot of those kind of DTC companies, obviously it's hard to build a new consumer brand. It costs potentially hundreds of millions, tens of millions at least, of marketing. And then a lot of the time they were losing money. Like they'd spend $100 to acquire a customer with a lifetime value of 99, 98. And I think that doesn't mean they're bad businesses. I just think that those are not necessarily venture businesses. Those businesses could have been built more slowly, profitably with revenue financing or something like that with a little bit of equity. So I think that that's more what's happening because, if you get onto the venture bandwagon and that just requires growth, and that it requires growth because there will be another growth investor. Once there's doubt about that future, then everything falls apart because you are not structured to be the last and final investor. But you need that exit, the IPO, or at least another investor to take it from you and support it. So I don't know what's going to happen in that world going forward, but I think that it's almost like more like a finance problem that, that's a private equity type opportunity of owning a big chunk of a company for future cash flows. And, there's been PE buyouts in that space.
Yeah. Okay. One question that I have, but that was like later down the list. But when I ask you right now that because when you mentioned IPO, what's a good time to go for an IPO?
I don't know. It's like there's different ways to answer that. I think that from a macro point of view, it's impossible to know, right? It's like, there's these windows that open in the market where somebody does an IPO, it goes surprisingly well, and then everyone rushes. So like I'd say that this is not my world, but there's always been like Airbnb was in this, and so indirectly being a shareholder, I was just watching and waiting, and we kept thinking it was going to go public years and years and years ago, but they waited for the market conditions, right? So I think that there's always these late stage companies that want to go public, but they have to wait for the right time. And that's, by the way, why the whole secondary market emerged was to help people get some liquidity for companies that were waiting 10, 12 plus years to go public. So I'm not an economist, so I don't know anything about that. From an entrepreneur's and the founder's point of view, it's almost like it doesn't matter. You don't build a company to go public, even though, of course, you would love to, and your investors would really love to. But you build a company to be as successful as you can, and then at the end, whatever happens, hopefully it goes well. You have a number of off ramps. So if I look at the Loom sale to Atlassian, I think they sold for $900 million. That was not the exit they were looking for, right? It's an exit that all of us can envy and like high five, amazing. But when they raised their last round, they wanted, I think from Andreessen Horowitz, they wanted much bigger exit, right? Or their investors did. And I'm not going to say it doesn't matter, because of course it matters, but it means that most entrepreneurs would be okay with choosing a $900 million exit, or $1 billion, or an IPO, or a $500 million. Like you're in the range where if you, by the way, if you want to exit, a lot of people don't even want to exit at that point, which is amazing. But if you do, it's like it doesn't matter at all from where somebody sits early stage. And in fact, I'd say, I know it's not exactly the question you asked, but it's,
Please go
I
ahead.
think that in general, like we spend a bit too much time thinking about the outcomes and the futures. A lot of it's, because the investors ask, right? It's fair for them to say, do you ever want to sell this company? Because if not, I can't invest in your company. I need to get money out. But that's different. Like that's their perspective. Your perspective as an early stage founder should be, how do I build a great company as big and beautiful as I can? That could be a company of one person, a company of 1,000 people. It could take you 1 year, it could take you 20 years. But as long as you're passionate about what you do, who cares? Like just who cares because you can't really do anything about it, but work hard. And who cares because by the time you get there, you will also be a different person. Your whole mindset will be different. It's just a big waste of time.
Yeah. One thing that you mentioned now, the Loom thing, I did not know, like, that's not the exit they were expecting. But going a few weeks back, I think that was time when Instacart went public,
Yeah.
right? And somebody, I think he's a person who was like some sort of an analyst or like some higher up in Carta. He published a report sort of a thing. And he did a breakdown. He was like, so somebody who invested like early stage, they made that much amount of money.
Yeah.
Yeah. 60x, yeah. But the math that did not add up to me was like, I think it was Series C or Series D. At that point in time, investor, whatever they invested, they just, they just get the same money out. Like they did not make any return on that.
That's just musical chairs, right? At a certain point, the music stops, somebody doesn't get a seat. If, like in that case, it's just that like the last investors assumed there would be another investor or an IPO that's higher. It didn't work out. I think they all got their money back, so nobody feels sorry for them. It's, I will say that it is really hard being an early investor because number one, the amount of time it takes to exit, it can be 15 years easily. And I think a lot of people have this misconception. Like if you ask people the average amount of time it takes to exit, a lot of people will say like 8 years or 7 years. In reality, the data, if you are a founder or let's say an angel investor, it's more like 12 years. And it can be obviously much higher. So it takes a lot of time of waiting. And along the way, all kinds of bad stuff can happen to you. Like I remember at Year One Labs, we had an investment where the VC, other VCs invested after us, who shall remain nameless. And when it was, we were negotiating the sale of the company, the VCs just said, who are these Year One Labs jokers who own, I don't remember, like under 20%, maybe 15%, whatever it was. And we're just going to take 80% of their shares. Otherwise, we're going to veto this deal. And the details are not important, but the fact is that this happens all the time where people just want to cram down early investors. Sometimes it's fair because maybe, your uncle got 70% of the company and that doesn't make any sense. But other times it's just, you know what, I have the gold and I make the rules. That's the golden rule. And all that means is that it's a disincentive. I certainly remember this when I write an angel check. I think, boy, maybe I own 1% of the company, but I might own 0 because somebody later on may just say, I don't want Raymond to be on the cap table and I won't invest 10 million if he's on the cap table. Not that hopefully it's not personal against me, but it could be like, all angels with common shares. We don't like you. We're going to cram you down 90%. Otherwise go to hell. This does happen. And we were fortunate that our entrepreneurs, our founders stood up for us. And, but this is what is scary about being an early investor. And, I think a lot of people think, oh, it's not fair that early investors got X%, but they didn't put in that much money. But nobody, we put in all of 100% of the money that was available at that time.
Yeah. And so it was a like very, very high risk sort of a thing for you guys to like just go all in without even knowing if that thing is going to work or not. So obviously the returns would make sense.
Yeah. And I think I do tell people don't expect to make money if you're an angel investor in general.
Yeah. Somebody told me that before. So the first check that I wrote was 3,000. And then one of the very kind friend who runs a VC firm, and then I asked him, I was like, hey sir, this is the first time I'm doing that, and he was like, just be prepared to lose all of that.
Yeah, most angels are, And like nobody likes to lose money, but most angels understand that the thing they are investing in is risky, and that's why they're doing it, because the risk has a potential high reward, right? And whatever the numbers are. What I'm saying is, on top of the inherent risks in startups, which are the same for VCs and angels, angels in early stage and accelerators have it even worse because they have to wait another 2 or 3 years, to their time horizon. And so there's a lot we could talk about early stage, but I do think that, going back to what we're saying about culturally in different countries, like one thing America is so great at is I'm going to write you a check and I don't want to lose it, but if I lose it, that's business. Let's move on. And I do think that's part of the culture of like supporting entrepreneurs and not punishing them. Canada, there's a bit more of a, tall poppy syndrome still, where we don't like talking about wealth and success. So we don't, the flip side of that is feel a bit uncomfortable about failure, not just a bit, a lot.
But the flip side to that is, and probably like 6 Canadian that I have on the podcast. So the thing that I really like about that is every single person that I talked to, they just did not build a company just because, just like it's cool to build a company, I'm going to make a lot of money now. Everybody has a purpose behind like whatever they're doing. And everybody like so passionate. You can tell people like when they're passionate about something. Like I'm passionate about soccer. You can talk to me like all day long. You can tell I'm passionate about F1, so you can talk about, okay, so this dude doesn't understand all the things.
Yeah, that's the difference, right?
Yeah, it's something like, we're like not building a company. It's not the case in the US. It's just like, the opportunity is there. We're gonna make a lot of money and like whatever.
Well, I mean, I'd say that like I haven't necessarily found that. I found that in startups, at least, it's pretty common that this passion, this desire to do something, I think that's pretty common. In the US.
Otherwise, you cannot build that, because in anybody's sane mind, you cannot go through that turmoil sort of a problem.
But one difference is, I think Americans, we're just like using generalizations here, right? But in general, I think Americans are more able to say, okay, I've got a huge vision, my passion, we tried it didn't work. Let's move on to the next thing, and that might be a 2-year window, right?
Yeah.
Canadians fail slower because of this. I don't want to fail, and I don't want to be seen as failure. So I think that is something that, if we measure the success of the two economies, one is your failure velocity is higher in the US, which means you have more successful.
Yeah. Okay. So one small thing, and just gonna go through towards like what the audience questions that we managed to put together for you. So how do you think AI will change fundraising? Like everybody talks about like how AI is going to change entrepreneurship, but my question to you is how it's going to change fundraising.
I think it's going to radically change fundraising. I hope it changes it even faster. I mean, there's so many bad and kind of unnecessarily bad things about fundraising, just even finding investors. And I think AI is going to really help that. And I don't think people who don't fundraise for startups understand just how old school and inefficient it is. I think that AI is finally going to alleviate some of those issues, getting access to large data sets, and just sort of like saving time. But it'll be on both sides, right? AI is already helping VCs get better deal flow, and it's going to help entrepreneurs get access to more capital. I've thought about this as I could see a future where a lot of that initial connection point is not like conferences and cold outreach. It's your agent or AI bot talking to a VC AI bot, getting to know each other, negotiating, and then connecting people when it matters. That can happen in your sleep. I think a lot of people think that's going to happen, and in my mind, it can't happen soon enough, because it's just there's so many inefficiencies that I think AI is in particular. We're talking about like the kind of ChatGPT, large language model, that type of using language and data processing to solve problems. I think that's going to be really useful.
Okay, all right. So Ray, we have a decent big of an audience. Very fortunate to have 12,000 plus people on that list. So what we do is I send out an email to everybody. Hey, Ray is coming tomorrow on the podcast. Any question that you want me to ask him? There's like all kind of questions. Really crappy ones, really good ones.
Yeah. Well, ask me the crappy ones.
You really don't want to know. You really don't want to know. Yeah. So I've managed to put like, I think 5 or 6 of them because they're the ones that you've already, answered during our conversation. So just want to go through all of them and just quickly take your, take on all of them. Okay. So the first one is, and you're going to find it funny, why VCs not share productive and honest feedback?
I think they do. Like, I disagree that with the question. I think that I know where the question is coming from, right? I've a lot of VCs have given annoying and opaque feedback. The answer is, rare is the human being that can just look at you and say, I don't like you and I don't like your business, and that's why I'm not investing. So they're going to find 101 ways to let you down. You're too early. You're not really in our thesis and doing this. So I think it's mostly the issue is on the founder side. Is don't go looking for validation from a VC. Don't go looking for the perfect feedback. Look for money. And if the answer is no, figure out that it's no and move on. The VCs are not in the feedback game, even though it would be nice if they gave you feedback. It would be nice if they're helpful, and many, many, many are helpful. That's just not their job, and that's not what you should look for. Look for the yes or look for the no, and then move on.
Okay. A lot of people don't know when somebody's saying no to them.
Yeah, that's kind of the same question. It's like, I think that it's a lot of that you can figure this out first by doing research. So don't go ask a growth fund do you invest in the early, like pre-seed, and you're going to get all kinds of no's. You'll probably just get no. I think a lot of the research is like, you should know like, does the fund invest in your space and your size and geography and industry? Have they invested in a competitor? What is the history of investing of the partners in the fund? You can find this. It takes a long time, and maybe that's like to solve that problem one day, but that takes AI can maybe solve this problem. But if you can figure that out, then the quality of the no's you get will be better, because it's not just random noise. It's going to be, we really like what you're doing. We don't think that we don't think that you're a fit for us for these specific technical reasons, or we don't believe in the team. You're going to get better quality no's when you start reaching out to better quality people.
Perfect. What's the best and the worst pitch you've ever seen?
Probably both the best and the worst probably came from myself. Like, I've made the absolute worst pitches. One time I was in, I think I was pitching Oracle Ventures in San Jose. And the pitch itself was fine, except that I had just gotten in a snowboard accident the weekend before. So check this out. I show up, I went off a jump and landed on my face. So kind of like scraped part of my face off. I had 2 black eyes, like a raccoon, a chipped tooth, bruises. I couldn't really breathe because I had bruised ribs. So I show up there in my ill-fitting suit, looking like a raccoon. And that was my worst pitch. And maybe they talk about me, like the raccoon guy. I certainly remember that. I'm not going to say I made the best pitch, but like, I think that there's, there are, like, the best pitches I've heard actually are ones where I don't really even remember so much about the product or the content, but I really remember the entrepreneur, right? That, and it's not like, a lot of people make the mistake of thinking it's about like showmanship, or, getting coached on how to speak or not speaking with an accent, and none of that matters. There's just something that when an entrepreneur is really passionate, confident, and comfortable, and you feel like you could just talk to them forever. And that is something that fortunately, because I work with founders, I get that a lot. And that's what inspires me. It's like, wow, this is somebody I want to get to know. And that's ultimately the purpose of the pitch.
Okay, awesome. What about those investors who don't care about the pitch deck at all?
Yeah, I mean, it's not like, the goal is not the pitch deck, right? I think it's pretty rare to find an investor that doesn't care. I mean, some of them do that kind of like thing where you go in and they close the laptop and they look at you with these kind of earnest eyes and say, just leave that aside. But then they like interrupt you, and you really wish you could just get to what you wanted to say. So there's little things that do that, little VCs that do that. But I think that in reality, the pitch deck doesn't matter. It's the quality of, like, the pitch deck is still the most efficient way, number one, for VCs to screen if they even want to meet you, which happens. And number two, it's about formulating in the founder's minds all the things that are important. Then what order, or does it actually happen? It doesn't really matter, because everything is there. And I always think of it like what you're trying to achieve, and hopefully, and I think VCs believe this as well, is if I'm sitting down for lunch with you, I know I'm going to get the same content as if you were pitching me formally. So it doesn't matter that much, but I think that a lot of VCs, it's still like the best data package, because you're going to get like it just like think of it this way, because it's somewhat standardized, you're less likely to have to ask dumb questions, right? So you get everything out of the way, then you can ask non-dumb questions after that.
Okay. What do you look for in a founder before you invest?
I look for a real reason that they care. I always ask, like, why do you care so much about this? One time I was teaching at a student group, and this young student man comes up to me and says, I've got this great idea for this woman's dating site. It's going to be very positive for women. And I was like, why do you care so much about this business? And he didn't have a good answer. And it wasn't like he was trying to get a date either. It was just, it wasn't really a good business. And like, I just really want to know why somebody cares. So if it doesn't matter what it is. It's never like, because I want to make money, because I tell people there's better ways to make money. It's why are you so passionate about this? Because I find that it's not just an annoying question. It's really, that's when you find everything you need to know, about what they really care about. And after their, company pivots 50 times, the thing they still care about is still there, right? The product is different, but the passion and the mission is still there. So that's what I look for. Now, it's not something like bullshit. It's, if I sit down with a founder for 1 hour and just talk, and after 5 minutes, we have nothing more to talk about, that's a big concern. Not just as an investor, but just, I'm concerned for that person, that they just haven't really thought about this deeply. And you need to do that, right? So like you mentioned soccer or F1, like you could talk about that all day long. And I think whatever your passions are, that's going to make you happy in life, but also it's going to make it easy, because if somebody says to you, now you need to go do this research, you're going to love doing it because you care about it. Otherwise, it's like, oh man, I don't want to raise money because I have to do a pitch deck, and the pitch deck means I have to do this, and I don't want to do that. Well, maybe you don't want to run your business either.
Okay, awesome. So Ray, thank you. I appreciate all the candor, all the knowledge that you shared. We do have this one small ritual on the podcast since episode 1. What we do is we ask all our guests a question for our next guest without telling who the next guest is going to be. So we got a question from you, a question for you, and then I'm going to take a question from you after the recording. So, we can have it for the next guest. Okay.
Okay. Yeah. Okay. I got it. Wow. I'm really excited.
Okay. So the last person that, who happens to be a VC, he asked a question like, what's one contrarian opinion you have about the future of entrepreneurial finance?
I love that question. I think that the companies of the future, are going to leverage AI in a way that they're going to look very different. I think we're going to see a lot more companies of one person and no employees, and not every company, but I think that that's really going to affect. It's funny that as a VC asked that, because I think it's fundamentally going to disrupt a lot of VCs. If you think about what venture funds, a lot of it's just headcount. And I think that, so this is obvious, right? If a lot of venture funds headcount and a lot of AI is going to disrupt headcount, therefore VCs are going to be disrupted. And I thought about this a lot, that, like every founder dreams about a successful company with no staff, because anyone who's managed human beings, as much as we love human beings, and I love every single one, sometimes you're like, man, just give me an AI and I can turn the AI off and reboot them. So I think that, but joking aside, it's the other thing that it's not just like how is the next Airbnb going to be built with AI? And I think that's going to be the same as it is, like big venture dollars, big staff. But the way I see it is a little bit differently, that there'll be a kind of like a B class of companies where it's not winner take all right now, as it is right now. There can only be 1 or 2 or 3. But with AI, there could be 10,000 very similar, almost commodity products in a space. There doesn't need to just be one. And if there's 10,000, maybe all of those companies have one owner and just run by AI, and they're not billion-dollar companies. They're $10 million a year companies. But that can be something that is really great for a lot of people. I think that's going to change, is we're just going to see a new type of structure, which is smaller, lighter, maybe requires no money. And that's obviously going to disrupt VC, but there'll be new types of financial products. And I'm excited by that, because the diversity of, hey, I'm just going to spin up a company, and you can already do this with GPT-4. Take a photo of my screen, you write the code. That's pretty cool. Like, imagine how many iterations you can do with that without having any engineers, even though I love every engineer and I always want to hire them, and they're amazing people.
So thank you so much, Ray. This was probably the longest episode that I've recorded since Alistair's episode. So thank you for the time. Thank you for the knowledge, that all the things that you've shared. Really love talking to you. So really appreciate it.
Thank you. I will never beat Alistair in the length of interview question. I don't even try. And I worked with Alistair. I love him so much. That's great. I love talking, I love talking to you. I love talking about founders. There's so many interesting topics. I learn a lot by talking. So it's something that I'm passionate about, and congratulations on your success, and you're building something you're passionate about. I'm a fan and looking forward to hearing more podcasts in the future.
Absolutely. Thank you so much. This is it from today's episode. I hope you enjoyed it. Thank you so much for watching and listening. All the resources and links that we have talked about, they're all in the description or in the show notes, depending upon which platform you're on. If you're listening on Apple Podcasts, please give us a review. Would appreciate it. If you're watching it on YouTube, please mention down in the comment, did you like it? Did you not like it? What do you want us to improve? What do you want us to invite on the channel? If you enjoyed this episode, there are chances you're going to enjoy that episode as well. So we're going to link it down somewhere here. Do hit the subscribe button if you haven't done that already. And thank you so much for watching again. And I'll talk to you soon. See you in the next one. Peace.